Hello, my dear friends. This is your friend Vivek Bajaj, co-founder of StockEdge and Elearnmarkets. Friends, yet another face-to-face global and yet another super excited video. I'm going to touch a very important topic today, multi-time frame analysis. And with me, I have the master of multi-time frame analysis. You're going to enjoy this video, this learning. Please watch it till the end. I mean, it takes an effort to reach out to the right people and get them on board for your learning. This is going to be very exciting learning. We are going to discuss multi-time frame. We are going to discuss a very important indicator which the expert is using. So hold on. This is great. And if you have joined me for the first time, Face to Face is a series which I run. It has more than 45 million views. And if you have not become part of Face to Face, do subscribe to the channel, Elearnmarkets. Well, without spending too much time on this, let me welcome dear friend Brian Shannon. Hi, Brian.
Hey, Vivek. Thanks for having me on here.
Good morning from India and good evening from US. Yes. Did I spell your name correctly, Brian Shannon?
Shannon.
Shannon. Okay. Thank you so much for correcting me there. So it's great to connect with you. And, I know you're very active on Twitter and we got connected through Twitter. That's the power of Twitter. You can reach to anyone at any, within any objective. And I know about you. So let me just introduce people to you. Let me just introduce you to people. See, I'm already nervous, but I'll try to keep my cool and calm. So let me introduce Brian Shannon is an American author and technical analyst. He published his book called Technical Analysis Using Multi-Time Frame in 2008. He's an avid educator. He's a market participant. He's a trader. And, he's one of the best indie traders in the business. That's what people call him. So, this is a short introduction from my side, but obviously we want to hear more from you, Brian. How did you start this journey? What has been your background? Please tell us more about you.
Yeah, sure. I first got my interest in the markets through my dad. He would watch Wall Street Week here in the U.S., which I'm not sure if you guys are familiar with. When I was a teen and 12, 13 years old, I would sit there on Friday nights and watch this market show with him. And I started picking up little things about the market and asking questions, and then finally did a trade. My first equities trade, I think I was 15. I had put up $500. My dad loaned me $4,500, basically 10-to-1 margin. And we bought 1,000 shares of a $5 stock. That stock doubled in the next 3 months. And needless to say, I was hooked on it. I thought, why do people get jobs? Why would anyone work when you can make money like this, especially at that age? So that was, I graduated college in 1991. From there, I went to Lehman Brothers in Boston and worked as a stockbroker for a little bit, moved to Denver, Colorado in 91 as well, 92 actually. And I've been here since. And, during that time, I was a broker for a retail firm for a little while. I like to say I got the opportunity to practice with other people's money. And, I did make mistakes with other people's money, but it wasn't, big mistakes or anything like that. But I definitely learned a respect for risk. And, after about a year or so of being a broker at that firm, I branched out, basically graduated from a salesman, which a stockbroker is basically, to a trader. I, found a firm that gave me leverage, and I used, every last penny that I had saved, and, went to work for this firm trading. It was, I think I was 23 years old, and man, if I had to do it again the way I did it back then, today, I don't think I would, meaning that, I was young and I could afford to take risks. I had nothing to lose, basically. So, I did have a strong respect for risk. So I was immediately profitable, and profitable each of the months that I was with that proprietary trading firm out of New York. I opened an office for them in Denver and then opened my own day trading office. So this was, 1993, 94. And then kind of started with another firm where I headed up their prop desk, some educational content. I still have traded pretty much every single day since then. So, really my passion for the market comes from my day-to-day activity in the markets. So here I am today. As you said, I wrote my book in 2008. I'm working on another one based on, the anchored volume weighted average price. And I run a site called Alpha Trends. The best way to find my information and where I put out, all my public stuff is on Twitter, where my handle is Alpha Trends. So that kind of gets us up to speed here.
Yeah, absolutely. Yep. So, Brian, so you said that you graduated in 1991. So how old you are?
I'm 54 years old.
Oh my goodness. Okay, let me ask you this question. Do you think fitness has anything to do with success in stock market?
I do. Yeah. And I try to stay healthy and active. And, I think you hear the phrase healthy body, healthy mind, healthy body, they feed each other. And, when you maintain physical fitness, you sleep well, your brain is rested, you can engage in, a pretty stressful activity, and where you always have to be thinking, especially on the time frames that I'm engaged on. I'm a swing trader primarily. Mm-hmm. So I ideally like to hold stocks, a couple days to a couple weeks, but it's up to the market. It's not up to me how long I hold. If I decide how long to hold, it's probably going to be a loser. Mm-hmm. In other words, if I'm not listening to the market, especially now with all the volatility that we're seeing in the markets, that I've got to listen to the message of the market. And right now, today being what's the 24th of January, we had an extremely volatile market in the U.S. market. And I did nothing but day trades today, simply because that was the opportunity there. I don't necessarily want to be a day trader, but I'm here in front of the machine. This is what I do, and that's where the opportunity is. Again, I have to listen to the market. I can't, tell the market what I want. It's not going to listen to me.
True. And one more question is that if you look back your career, your life, would you like to change anything there?
I get asked that from time to time, and I could say, well, I wish I did this or I wish I did that, but where I am today is it's based on all the mistakes I've made. It's based on all the successes I've had. Yeah. I'm really not one to look back and regret and do shoulda, coulda, woulda type stuff. I'm where I am today because I went through the school of hard knocks. Now, maybe I could have done things slightly differently. I honestly don't know what those things would have been because, I learn by doing. My biggest mistakes have been my best lessons. Yep. And without, I could say, I wish I didn't lose that much money that one day or that 1 month, but it makes me who I am. So I really don't think about it that way. I think about, here's where I am. Let's engage with the cumulative knowledge I have and try to be as best as I can be here today.
Sure. The last question before we go to the conceptual discussion is that, there are a lot of youngsters who have come into the market and immediately after graduation, they have just gone into the market. Okay. And you worked in some reputed firms before you actually came into the market full time. For example, you worked in Goldman and Lehman, you just mentioned. Do you think that experience of working in a large firm shaped your career to take a better decision to do on your own? Or let me put it the other way. Do you think a youngster should not get into the market from day one, maybe work somewhere for some time, get that right experience, and then get into the market full time?
I think you're better off, not getting into the market full time right away, because you're going to be there making a lot of mistakes, not learning from your mistakes, rather than getting some guidance from some structured program, whether it be, go get your CMT, for instance, or go work for an investment bank under another trader. Try to figure out different areas in the market, and maybe trading's not the right route for someone out there. Maybe they're better off as an investment banker. Maybe they're better off as a broker or going into mortgages or selling insurance. You don't know until you try a few things out. and when I was starting out as a retail broker, my manager at the time said, you have to get your insurance license. And I was like, I don't want my insurance license. I'm not going to pass that. I'm not doing it. But I did pass it. I learned some good things, and I was stubborn, but it gave me the experience to see things differently, see things through a different lens. If you can work, especially if you can, find a way to go work for a big fund and figure out how the big money really moves money and markets around, and then figure out how to, look at different time frames. And that's the key. It's not just what area of the market you're going to be in. One of the most important things is time frame, and knowing your time frame, that we can be in a bull market on one time frame, but be getting the snot kicked out of us on a shorter term time frame where you're just losing money day after day. And people will say, hey, but we're in a bull market, but your time frame is, you're leveraged up and, making all the mistakes that young people make. So go get a job somewhere else. Get a salary, get some benefits, learn some things, squirrel your money away, do some trading on the side, and then progress to being a full-time trader.
Sure, that's pretty fair advice. So, Brian, I'm blessed that today is the day when market was very volatile, and
Right.
you actually traded from swing to day. So, if I can also get some input from you, that how do you trade in these kind of a market using the methodology which you will share with us? So, can we just start the discussion on the concept?
Yeah. So basically, Vivek, the markets, as we know, are fractal. And for people that don't understand what that means, it basically means if you take your analysis on a weekly chart and look at the trends that they're in, you could take that same chart, not know that I could tell you that it's constructed of monthly bars or candles, but it might actually be constructed of 1 minute bars or candles. And you honestly wouldn't know the difference a lot of the time. So the point of fractal is that the patterns repeat on different time frames, which is great because that's what makes technical analysis transferable from longer term investing to swing trading to day trading. Once you learn the concepts of trends, how they're formed, how they develop, how they're sustained, where to manage risk underneath successive higher lows in the longs or above lower highs, it doesn't matter what time frame you're on. You can use those same principles on any time frame, and those are looking at multi-time frame analysis, looking at basic tools, price, volume, and again multi-time frame. So the three of those are the basis of the volume weighted average price. Price, only price pays. Volume tells us the intensity of the market moves, and time. So today we saw the biggest volume in probably a year in the S&P 500. We were down a whole bunch in the morning. We rallied back and closed right near the highs. So it seems as though it's a near-term turning point to measure risk against, and it's always about risk management.
True. So let's get it going. So I guess you will share the screen and let's go through the concept. You have made a lovely presentation for us. So first of all, thank you for that.
Okay, we're good?
Yeah, we are good to go.
Okay, so we're going to focus a lot on the anchored volume weighted average price. And one of the biggest questions I get is, where do you anchor from? And we'll get to that. But first, before we cover any of this, the first thing you have to understand is basic market structure. And this is something that I learned from Stan Weinstein. It's also, been written about by Wyckoff and a guy named Joe Kerr back in the early 20s. But what it does is it breaks down the market cycle into 4 stages. The accumulation stage is kind of where it's been in a previous uptrend and it's broken down and gone sideways. And, there's a phrase during these, if they don't scare you out on the way down, they'll typically wear you out. It's the process of ridding the sellers and the buyers regaining control. It's basically a period of neutral market, that I don't want to be involved in as a trend trader. Instead, I want to focus on, for longs, this stage 2 uptrend. If we're in an uptrend, well, then we're innocent until proven guilty, meaning that, we expect, based on, Charles Dow and the tenets of technical analysis, one of them is a trend once established is more likely to continue than reverse. So I don't want to buy after the 5-day surge, but I want to anticipate the little moves after, a 3 to 4 day pullback and use multiple timeframes. So that's what this chart is showing here on the left, is if we took this little boxed in area during this stage 2 and we said A, B, C, D, if it's pulling back on the short-term time frame, we don't want to get involved. And actually put an example in here with one of your Indian stocks. And I will, forgive me, I've never looked at an Indian stock in my life, just because I'm US based, I trade US stocks, but the concepts even there, we can look at some live ones and they're going to be the same exact concepts. Stage 3 occurs after the markup. We have a chance where the market starts to turn sideways. And we certainly saw that, for instance, the Russell 2000, the S&P 500, and now we're in a stage 4 decline in a lot of these markets, guilty until proven innocent. So what we want to do is come up with a plan of action for each one of these stages. So in the accumulation, stage 1, where it's kind of going sideways, we're going to anticipate where to participate in a new long, or we're going to cover our short because it's no longer going down. Instead, it's turned sideways. There's no longer an advantage to being short. Stage 2, that's where we participate on the long side. And we want to avoid shorting. Now, we can make money shorting stocks that are in uptrends, but the simple math of higher highs and higher lows means the sum of the rallies is greater than the sum of the declines. So there's naturally more opportunity to trade the long side and avoid the little pullbacks. Some people like to, short the little pullbacks. And if you can make money like that consistently, that's what you should do. And that, that's one of the keys is Vivek, that, people have to find out what is their time frame, what is the market they trade. Are they commodity traders, US stock traders, crypto traders, solely Indian stocks? It doesn't matter. You've got to do what works for you. Don't listen to other people and say you've got to do this or that. Stage 3, the uptrend is kind of exhausted itself. You're going to start getting stopped out of your long trades. And you're going to start to say, hey, it looks like it has the potential to break down. So in the US market, we saw all these big leaders, Peloton, Zoom, we saw Roku, Square, PayPal. They were all breaking down prior to the index. So we were seeing, weakness under the surface. And finally, the index gave it up basically about a week and a half ago. So we want to anticipate where are the other short opportunities. And then in a stage 4 decline, that's where we participate on the short side and avoid the long side. Again, we can make money trading those bounces. And sometimes they can be, some of the most spectacular bounces there are, or, spectacular short-term rallies occur in a downtrending market. So if you're nimble and you can day trade, for instance, like I said, I was day trading today. We did finish positive. We were down most of the day. So we want to, anticipate the moves so we're not chasing things, participate when we have price confirmation, exit when the market tells us to, and then avoid it. So here's an example of Larson and Tubro.
Yep.
Okay, so this is, I guess, one of the nifty 50 stocks. And on the left, we see here's a daily time frame. It's clearly in an uptrend. This green line is the 50-day moving average. It's innocent until proven guilty with a rising 50-day moving average. There are pullbacks in here, and certainly you can make money shorting those. But the sum of the rallies, it goes from 1720 to 2000 back down to 1760. The sum of the rallies is greater than the sum of the declines. So this highlighted area here is simply this chart on the right. So we're magnifying it to 30-minute candles. And I don't even know if that's the proper amount of time for the Indian market. I don't know if those are equal, if there are 30-minute increments that are equal like they're here in the US. But this is how I do my analysis.
It's pretty much okay. It's pretty much valid for India as well.
Oh, okay, good. Good to know. So, in this period right here, just to this side, you can see we had, 2 down days, and then we have this kind of sideways. It breaks a higher high here. So we're anticipating, we're avoiding this little pullback right here. We're anticipating in here. And then as it breaks higher, we want to participate. And as long as it's making higher highs and higher lows on the shorter term time frame, then we want to stay with that trend and raise our stops up underneath these successive higher lows. When it makes a lower low, well, then we exit. That's it. The definition of trend is no longer valid for the time frame we're engaged in. So there's no reason to be involved any longer. So in there you can see that exit occurred. It didn't occur at the high. Only the liars exit up there, right? So we want to participate, in here. We don't want to try to buy the low. In other words, we don't want to buy pullbacks. We want to buy strength after the pullback. And then we want to exit as the trend gets tired and starts to make that first lower low. It's got this high, it's got a lower high, then a lower low. So as it breaks down, yes, of course, you can short this and make money. But because it's in a primary stage 2 uptrend, I look at it and say, I'd rather wait it out, wait for it to undergo accumulation again, and have the trends aligned. At this point right here, the trends are aligned. The daily time frame is in an uptrend, and this 30-minute time frame is an uptrend. That means I have the maximum, I have momentum in my favor. I'm getting in at the beginning of this unfolding move. I don't know how far it will go, but if it's truly an uptrend, it's going to at least, take out this prior high, which of course it did. And, then manage risk. And again, you can make money shorting here, but my philosophy is I want to look for trend alignment. And I personally avoid these because they can go against you really strong. And if you're going to short them, I like to say, do it with half a risk unit. If your normal risk unit is $1,000, when trends are aligned, only risk $500, based on where your stop is. And that's the way, I like to look at, first market structure and then start to add the tools.
Sure. Brian, this 1 day and half an hour, is it your standard template, or you keep on changing it depending upon the instrument or market condition or anything?
Yeah, well, on my screen, so I've got several screens, of course. I've been doing this 31 years, and I've started adding more and more stuff. My analysis remains really simple, but I like to have the extra real estate. So on my screen, I have a weekly chart up here. Then I have a daily, a 65-minute, 30-minute, a 15-minute, and a 2-minute. So when I click on a symbol, it populates all of those at once. Yeah. So I'm instantly aware of, the really big picture on the weekly time frame, the daily time frame, and that doesn't really get a lot of weight in my decision for a swing trade, but I still want to be aware. What are the key levels on the bigger time frames? Am I pressing my shorts too far because we're coming into this bigger level? Or am I, pressing my longs too much because we're coming into this prior big level of support, which has the potential to become resistance? So it's my main time frames, I guess, Vivek, you could say, would be a daily time frame is where I like to identify what my opportunity is. And then I will look at a 65-minute or 30-minute. So in the US, we're open for 6.5 hours a day. That's 390 minutes. So I want something that's equally divided into 390. So a 65-minute time frame, there are 6 equal candles. If I used an hourly chart, it would be from 9:30 to 10 a.m. Eastern would be 1 candle, and then 10 to 11, 11 to 12. So I'd have 1 30-minute candle and 6 60-minute candles. So the way around that is to make 65-minute candles. There's 6 of those that are equal, or there are 13 30-minute candles, 26 15-minute candles, 39 10-minute candles, etc. So that's where the 30-minute and 65-minute, I kind of look to see what's my risk reward. Is there sufficient reward potential here for my perceived risk? And then the shorter term time frames down into that 5-minute and 2-minute area, that's where I really like to fine tune my entries. Look at the daily volume weighted average price, maybe yesterday's volume weighted average price, and really fine tune my entries so I can get in just as the momentum is beginning on the shortest time frame, and hopefully it will become aligned with the bigger picture. And that gives me a head start on most other people who are waiting for breakouts, waiting for volume to come in. to me, it's price based first. I'm aware of the volume patterns and I want to see, volume expand on the way up, peak at the turning point, diminish on the retracement. And then as it starts to rally again, when I'm buying, the volume isn't there yet. The volume comes in an hour, 3 hours, a day later, often. I'm trading liquid stocks to begin with, but I'm saying the expansion of volume where people who've been waiting for volume, I might get involved in a $30 stock and they're getting involved at 31.20 because that's when they start to see the volume.
True.
By that point, I'm taking a third off and saying, go ahead, here's your breakout. There's your volume, take some from me. So it's always about anticipating and risk management. I want to take that first third off, even though I think it might be able to go to $35, $38 per share. I'm going to sell some at 31.20 or whatever the number might be, because I want to reduce my risk on the first part, maybe raise my stop to break even. Now I've taken all the risk out, and that's really the key, is risk management.
Sure. So can I safely assume that you try to enter in the towards the end of the stage one with a lower time frame, so that you are literally the initial ones to enter the stock?
Yeah, it's actually just at the very beginning of that stage two on the shorter term time frame.
Okay.
And I've gone in at certain times where I've seen that level where it had resistance the last 2.5 days at $31 or $30 per share. So I'll go in there and I'll look at my, I'll set an alert at $29.90. I'll put it in a level 2 screen. I'll start watching it. If I start seeing a little bit of volume, or, I see the offers disappearing, and just seems like the frenzy is about to build for this breakout, I'll go in at $29.95 and I'll put in a limit order for 5,000 shares at $30.10. If I see, 1,800 shares offered, I'll clear the book and create that momentum. And then if I get filled on, 1,800 shares, then I've got 3,200 shares bid at $30.10. That'll induce other people to either join the bid or cut in front of me or go take the offer. So I'm trying to help nudge it at that point as well. Now, I don't do that all the time, and you really need a good, healthy market to do that.
Yeah.
And you've got to have confidence in what you're doing, and position of strength for the week and for the month. So I don't want to give the impression that I'm out there moving stocks.
Yeah.
But sometimes I'll try to provide that catalyst as well.
Sure, got your point. Yeah, please continue.
Okay, so what we're going to mainly talk about is the volume weighted average price, and this is the scales of justice. And the ladies, the scale, I don't know what they call her, I should know this, is blind to all evidence. She just seeks the truth. So what we're talking about in the market, of course, is supply and demand. And what we're looking for is the equilibrium points and the points where that comes out of balance. And then we, and the volume weighted average price allows us to objectively do that. We are basically looking at this market with blinders in terms of support and resistance, and who has control, the buyers or sellers. So number one, price is the truth. It's the final arbiter. People argue all day long on Twitter or whatever about, no, you're not right about that chart, or you drew that trend line wrong. I really don't care. Yeah. I never debate people about a stock, and I've been doing it long enough. I have faith in my system that I know where my stop is. If you don't agree with me, go short it and I'll buy it from you. Don't argue with me about it. I'm not, this isn't an academic exercise. We're not competing for a PhD degree. We're trying to make money. So if you think that I'm wrong, go take the other side of the trade, because price is truth and it settles all of those arguments. And I'll get out. If I'm wrong, I've been wrong a lot. I'll continue to be wrong a lot, but I will protect myself and get out. Yeah. What we're talking about are the laws of supply and demand. They call them laws because they are truths. They are not the theory of supply and demand. They are actual truths of supply and demand. And that's what the volume weighted average price really measures without any doubt at all. It tells you definitively from any point where we start a VWAP who's in control, the buyers or sellers. So it's really the most objective measurement you can find. And I will challenge anyone to show me something otherwise, but it doesn't exist. So we want to be aware of where is the stock in relation to the volume weighted average price? What's the direction of the volume weighted average price? And of course, we're always looking at multiple time frames. We don't want to fight the bigger trend because we see a short-term, opportunity. If we do see that short-term opportunity and it's against the primary trend, again, smaller risk units to compensate for the fact that you're not trading with the primary trend. So the way I look at the volume weighted average price levels, people always say, hey, is that, do you buy pullbacks to the 50-day moving average? Just as an example to talk about the psychology, the 50-day moving average often acts as support. The reason it often acts as support is because we have so many people trained to look at it who have been taught that it is support. So they stop shorting as it gets down to the 50-day moving average. They might start to cover some of their, maybe it was 2 standard deviations above the 50-day moving average. So some big hedge fund shorts 100,000 shares and they cover it down at the 50-day moving average. They stop selling, they start buying back. And then what does sideline cash do? Well, you've got a mutual fund with 5 million shares. It ran from 30 to 35. They sold, I said they have 5 million shares. They sold 200,000 shares on the way up. 250,000 shares. It pulls back to the 50-day moving average. They'll stick in a bid for 50,000 shares because they want to protect the rest of their, 4.5 million shares they have left, and stick in a bid to induce other traders to come in and say, hey, look at that big bid. There's buyers there. So we have lack of supply. We have more demand from the shorts covering, from the institution trying to protect their position. And then you have sideline cash saying, hey, it's at the 50-day moving average. The 50-day moving average usually acts as support. I'm going to stick in a bid. And lo and behold, that's why we see the 50-day moving average or a 61.8% retracement or a volume weighted average price or whatever technical tool, trend line often becomes support or resistance because there's enough people coming to that same conclusion in the same spot. So if we have a 50-day moving average lined up with the volume weighted average price since the beginning of the year and a 61.8% retracement, let's just say we have all these 3 things coming together. Maybe we have the Fibonacci group all coming to the same conclusion based on, hey, I'm going to stop selling short. I'm going to start buying back, and they become stronger when there's a confluence of indicators. Right. So the way I look at it is, again, we identify that key level on the bigger time frame, and to me, that's the daily time frame. And then we look for evidence that the buyers are actually gaining control. We don't just stick in bids blindly, hoping that it's going to occur. We don't have to buy 300,000 shares. We're looking to buy, maybe 500 shares, maybe 5,000 shares, maybe 10,000 shares. You don't have to do the dirty work of creating the support. Let the institutions do that. So to me, it's a place to say, it's a level of interest. Let's look at shorter term timeframes.
One question, Brian.
Yeah.
So, Brian, all these standard indicators like 20, 50, 100, 200, these have been used for many years. And, what I'm seeing that the algos, they have been mapped to these indicators. And because algos have also this character of fooling people, so they will typically take the price just below the 50-period moving average and reverse it from there. So what I'm getting a sense out of your discussion is, and please correct me if I'm wrong, that only one number may not be a perfect conclusion, maybe a convergence of VWAP, 50-period moving average, and certain more indicators. And if you have a range that, okay, the demand zone is around $30 to $30.5, that's the range typically one should accept as a demand zone rather than one particular price point. Am I right or wrong?
Oh, you're absolutely right. And to me, it's a bonus when you see a confluence of indicators. I was just trying to create the psychology of how each of those groups might come to the same conclusion in that same area.
Right.
And then what we do is we say, okay, we've got this level, the 50-day moving average. Let the other people, let the uneducated people stick it in at $30.08.
Hmm.
right? Because that's the number. But we have the predatory algorithms as well as what you're talking about, who are
Yeah.
just, and these are designed to go into these widely watched areas, run stops, flush them out, and then jack it right back higher. From failed moves comes fast moves, often in the
Hmm.
opposite direction. Those bear traps, those little shakeouts. So again, they're a level of interest. And what that means is, people say, hey, it's at the 50-day moving average. That's support. We don't know that until it runs away from the 50-day moving average. It runs from 30, 50 up to 32. Then we can look back and say, hey, look at that. Wasn't that awesome? The 50-day moving average was support.
Yeah.
Well, the next time it's not going to be. It's going to go through that and it's going to drop 15, 20%. And people are going to say, what happened? The 50-day moving average, it's support, but it didn't work. The market's rigged. Look at it as a level of interest. And what that simply means is look to the shorter term timeframes and look for evidence that the buyers are gaining control. And as it comes down after a 5-day decline, it probably takes a day to 2.5 days of trading back and forth in that band that you said, $30 and $30 to $30.50. And if it comes up to 30.48 one day, 30.47, then 30.52, 2.5 days later, that's where I want to buy. I want to buy at 30.52, and maybe the low the first time was $29.95, then $30.12. Maybe I'll stick my stop at $30.10, a couple pennies below that most recent relevant higher low. So on the short term, I have that higher high, and I want to set my stop under the most recent relevant higher low, because if I have a higher high, to me it says, now the short-term time frame is looking like a budding uptrend.
Yeah.
I have my higher high. What would break this emerging definition of uptrend? Well, if it made a lower low. So if my most recent relevant higher low was at, what did I say, $30.12, if it breaks below that, well, then I want to get out of the stock, cut my loss. I can always get back in, but maybe it drops down to 28, 27, 26, etc.
Sure. Got your point.
Yeah, so it's multiple time frame analysis and trend alignment. Let me do this. So again, as I mentioned earlier, price, volume, and time. That's the components of the volume weighted average price. Time is the most subjective because we all have different time frames. I'm a swing trader. Some people listening might be investors. Some people might be scalpers, which they're trading off 30-second charts, let's say. Whatever it is, that's your time frame. It's not a bad time frame. You can't feel bad. Let other people say, oh, you shouldn't do this or do that. You do whatever works for you. So what we want to do is say who's in control, the buyers or the sellers, or do we have this equilibrium? So when the demand is greater than supply, obviously what happens? Prices move higher. That's a stage 2 uptrend. When we have sideways action, it's either after a rally and it starts to turn sideways, possibly distribution that leads to a decline, or after a decline, it accumulates and then leads to an uptrend. When supply is greater than demand, prices move lower to find enough demand to support the prices. So when we look at a volume weighted average price, and here this is, just one day, and these are, I think, 1 minute candles. Here this market gapped up this particular day. So you anchor a volume weighted average price from the very first minute of the day. Market rallies up, pulls back, finds buyers who are defending that volume weighted average price level, has another rally, stays above that VWAP, stays above it, crosses back and forth. Now we're kind of in this equilibrium level. It's gone sideways. If it broke back above this 365.50, it would have been a continuation. Instead, it broke down through this little support in the VWAP, and then the sellers took control. We had lower highs and lower lows. So for a shorter term day trader, there's a great opportunity here. Let's say we just shorted it right here as this little rally, or let's say even right here at 363.55, let's call it, with our stop just above this little lower high. That's a great little day trade on these 2 minute candles. On a bullish time frame, what we want to see, here's a 1 minute time frame, a bullish chart will tend to find buyers at the rising volume weighted average price. So if the market is above a rising volume weighted average price for the session, I don't want to short it. Some people will try to short it up here and cover for 12 cents. I'd rather look for it and say, I want to buy it as it's breaking this range here, this tight range, buy it right here with a stop, worst case under here, maybe even under this little low from a very short-term standpoint. And again, the fractal nature of the market says this could be weekly candles right here. There's no difference in the analysis. And the opposite of true is, of course, on the short side.
Sure. So why is it called anchored volume weighted average price? What are we anchored?
Yeah, good question. So the traditional volume weighted average price, the one that we hear about, the VWAP, is for one day. The volume weighted average price was a benchmark for institutions to say, how well is my order executed? I run a hedge fund, and I give Goldman Sachs an order to buy 200,000 or sell 200,000 shares of this stock here. It closed the prior day at 177. So I want to know, how well did they do for me? If the volume weighted average price at the end of the day is 170.80, it means the average price based on volume, every single transaction, you take the average price and divide it by the volume. The average price it traded at was, the arithmetic mean is 170.95. If they came back to me and said, hey, we sold your order at 166.50 or 168.50, I'd be like, man, that's $2 below the VWAP. You guys, what are you doing? You screwed me over. But if they, let's say they executed the bulk of the order up in here in the morning because they knew that it was going to be, a lot of pressure, or they anticipated that, and they came back to me and said, hey, we filled your order at 71.85, I'd be like, you guys are great. I'm coming back and giving you business. In the past, though, before the volume weighted average price became a benchmark in 1988, an institution had no way of knowing if they were getting robbed by their broker, which they probably were back then before we had this transparency. So that's why the VWAP was invented. The anchored volume weighted average price is when we set it from any point other than the beginning of the day. Okay. So we can anchor at the 10:15 low of the day, and we can set our anchor at that 10:15 low. It comes down, starts rallying up. We say that looks like a high volume event at 10:15 a.m. I'm going to anchor a VWAP from there and see if the buyers can maintain control from that point forward. And then it rallies up, makes a high at 1:15 p.m. and backs off, a 0.5%. I know that was an important high. I'll anchor a VWAP to that. And again, I'll do that on daily charts. I'll do that on weekly charts. I'll do it on, 30-minute time frames. Got it. So the anchoring bias is, something that it's called a heuristic. It's, it's that our decisions are based on, our anchor point in our mind. So for instance, the price we pay for a stock, we're anchored to that. That's how we determine success or failure in the market. If I pay $30.52 and the stock goes to 33, I know that compared to my cost, that's the most important price, what I paid. If instead it's down at 29, well, then I know I'm not doing a great job. So I'm anchored to that. We're all anchored to a certain, price. So price has memory. It wiggles into our brain and, gets stuck there. So it's how we measure our success. The way to really think about it, the volume weighted average price is dollar cost average, basically. It's the same thing. If you took $1,000 each month and invested it in Apple, in this case, the stock is trading between 225 and 197 when I put this together. So in the very first month, you bought five shares at a cost of $199.23. That was your $1,000. Well, the next month, the stock dropped to 190. So it was down 9 points. So we were able to buy 5.2 shares. When the stock was up at 235, we bought 4.25 shares. So at the end of this, what we want to say is, here's our volume weighted average price. Sure. Our average price was 206.60. That's our cost basis. That's our VWAP, our volume weighted average price.
Got it.
That's the way to think about it. It makes a lot more sense when people think about it instead of an institution buying 500,000 shares or whatever. So
Got it.
we're anchored to that. We want to know, some of the guidelines. It's very similar to a traditional time-based moving average. This is a cumulative average. The volume weighted average price takes it from one point forward and adds up all the volume, adds up all the prices times the number of shares divides by the volume. So we want to be aware, just like a 50-day moving average. Is it rising? If it's rising, it means generally we give the benefit of the doubt to the buyers. If it's declining, we give the benefit of the doubt to the sellers. If it's flat and the prices are going back and forth above and below it, a lot of people will say, well, that volume weighted average price is useless, Brian. It's just going back and forth above and below it. That's the beauty of it. That's the value right there. It tells us there's no trend here. Stay away from it. Wait for it to break the resistance. By that break of the resistance, set your stop and see if a new trend emerges. It's in alignment with that longer term time frame. So there's value in recognizing those neutral periods because it says stay away. Don't try to force the trade when nothing's happening. So is it above or below the VWAP? What's the direction of the volume weighted average price? So what we want to know is where to anchor from. This was a period with, back in the fourth quarter of last year for the NASDAQ, and it could be any period, any time. I always anchor from the beginning of the day, from the beginning of the week. So this was a Monday. That Monday, prices sold off. And then the next day, they got back above the volume weighted average price for the week. So at that point, it was, 1 day plus 1 30-minute candle here. So it's not a 5-day volume weighted average price. It's only a 5-day volume weighted average price at the end of the week. Instead, it's the week to date volume weighted average price. And you can see how the buyers defended that. And they defended it the next Monday morning. And then that next Tuesday, the sellers took control and they maintained control on rallies up to the volume weighted average price from that Monday. And into the next week they did. And then we got back up above that volume weighted average price. So this looks more confusing than it actually is because I added 3 of them at the same time, but I'm trying to paint a picture of how they come together. And perhaps I'm doing it in the wrong order. This was something I put on Twitter. So I put a lot of these on Twitter and then follow up with and say, here's the volume weighted average price from the peak. AMD had this really big rally that you can't see because I didn't include that here. But this was the peak. And we knew that was the peak when it broke down basically, let's say right here, because we had a lower high and then a lower low at that point. So once we have that lower high and lower low, we anchor a VWAP off of that peak and say, let's see how it progresses from this point forward. And you can see 3-4 days later, it rallied up to that volume weighted average price from the peak. Sellers were there waiting and they knocked it back down. And they knocked it back down again over here. But then we saw at the same time, when it made this lower low, it then rallied up and broke these highs. And it looked like, okay, this is a higher high, still below that VWAP, but this is a higher high and that's an important low. So let's anchor a VWAP off of that. So it rallies up, it gets back above the volume weighted average price from the peak. It was extended on a gap, so we anchor one off of that. Now the range is really tightening in here. And I was looking for this as a potential trade above this peak right here to buy long. If it had gotten above that level, I was planning on going long with a stop under this low.
Sure.
Maybe even that low because that's the most recent relevant higher low. We saw that there were buyers defending this volume weighted average price. So if it got above here, and then failed to continue higher, I would want to sell as it breaks back down. Instead, what happened? It broke down. So, we didn't take, so there was no trade. So we anticipate during these tightening consolidations of range, and we wait for price confirmation. It's very tempting to buy in here because, hey, they've got good earnings. The analyst said this. These guys on TV said that. But until it confirms price-wise that it's made a higher high, it's only a candidate for trading. It's not, so we want to, wait until we have that price confirmation. This is something I like to tweet when the market's in a downtrend. I tweeted it last Monday saying, don't buy the dip, buy strength after the dip. But what we see is, so here's, for instance, Starbucks. Starbucks is in this downtrend. And basically at this point right in here, maybe, late February, early March, we knew that it was making lower highs and lower lows. So we anchor a VWAP off of that peak. And people say, hey, Starbucks is a good company. I'm going to buy it at 75. Well, it's in a downtrend. Help yourself. I want to see it back above this volume weighted average price. I want to know that the average participant from this point is now making money on the long side. I want to know the average short is losing money. And that's what it's really telling us. So it continues lower, 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 all the way down to $50 per share. So the people bought it at 75 thinking it was down too much. They lost 33% just a week and a half later in a so-called quality name. Instead, don't buy the dip. It rallies up, it makes a higher low, and then it breaks that volume weighted average price. Buy strength after the dip. That's where we want to buy. That's where the buyers, the average participant long from here is making money at that point. The average short is losing money. So the buyers are back in control. We can buy here with a stop under whatever higher low is appropriate for your time frame. It rallies up again. It pulls back to the conjunction of the volume weighted average price from this low and this peak right in here. I don't buy there. Sometimes, a lot of people want to buy it there. Fine, you can do that. I want to buy it right here as it gets back above this volume weighted average price, and that's flattened out.
So you
again,
calculate. Sorry to interrupt you in the middle. So basically what you do is for every new swing high and swing low, you have a volume weighted average price.
Perfectly said.
And
Gaps.
For what period? Sorry.
Whatever time frame you're engaged on.
Okay.
So, if I'm day trading the E-mini, I'm going to do this on 1 minute time frames.
Sure.
I'll look at that low that occurred at 10:48 a.m. and I'll put a volume weighted average price off that. I'll look at the high at 11:18 a.m. and put a VWAP on that. I'll see them come together in the same exact way. So again, you ask a great question, and it sounds confusing at times, and that's why I like to use different time examples here. I like to show an example of a 1 minute chart, and some swing traders, investors are going, well, that's just crazy. This is just crazy day trading stuff. It's the same concepts on a daily time frame. It's the same concept over here on the right on this 30-minute time frame, where we do the same exact thing, where we see, from this peak here and this low, the price converges, energy builds, it makes the higher high right here. And we know for a fact at that point that the average short from here is losing money. We know for a fact the average long from here factually is making money. This is supply and demand. We have actual price-based evidence. You cannot refute it. So to take it right there, rather than wait for the breakout over here a couple days later, people want to buy this breakout, like I was talking about earlier. I want to buy here. And what happens? We know the volume typically will, do something like this. The volume will be, like this in here, and then it'll start to go like that. And then we'll have the biggest volume right there. And then it pulls back, and then we see the volume like this. People are like, here are saying, hey, look, it's breaking out on big volume. I want to get involved. And I say, sure, take a third of mine. I bought it right here. And then what happens to those breakout buyers? Oh, breakouts don't work. The algos got me. And you know what? They probably did. And I sold some to you too. Thank you very much for being uneducated.
So why do you say 1/3? I'm very curious because you have repeated this twice, thrice. So do you have a staggered way of booking profit as well?
That's a good question. I don't really have a target. On day one, I will often look at daily R2, traditional floor trader pivots.
Yeah.
Daily R2 is a place where I think I've seen some statistics, 80% of the range is 83% of the range is typically contained within daily S2 and daily R2.
Right.
And you'll often see that daily R2 is the exact high of the day because there are programs saying 83% of the time it trades within there. Let's sell a bunch of our stock at that level, and it becomes another self-fulfilling prophecy.
Okay.
I add shares there. So I'll take a third off there. I'll also often, so that might be right here on that day, just a $2 gain on a $120 stock. Even though I think, hey, it's in an uptrend, I expect that it should at least go to here and continue higher. But then as it breaks to this high, I'll say, listen, where does it come from? It's just come from, 111 to 120. It's getting a little bit extended. It's up, 8% in 5 days. I'll sell another third on the breakout, or at least raise my stop very close in there, so that if that so-called breakout fails, I'm going to get out of third really quickly. And I would probably have my other stop right here, and I would have been stopped out of the balance on that. So sell a third here, a third here, and a third here. And I might have gotten back in, or I might not get back in, but I'm okay taking the meat of this move and waiting for the next one.
Sure. And you don't add your position when you are in profit. Like with every new breakout, you add more positions?
I don't add on breakouts. What I might do is something, along the lines of this, is that if on day one, I buy right here, it rallies up, and let's say this is daily R2, and I sell my first third, and then it comes back down like this, and I have my daily VWAP is right here.
Right.
And the VWAP off the peak is right there. I might add that third back right here and set my stop on that third. And then as it rallies like this, I'll either set my stop under this higher low or something like this and get stopped out right there.
Sure.
Or I'll sell by the end of the day, at least, that third that I bought back, and hold a 2/3 position. So I will day trade around my swing trade position, but I'm not, if I buy it here and I sell there, I'm not going to add here. I'd never want to buy the breakout. I want to buy after the pullback. Same story. Once we have this compression of range and the volume weighted average price off the peak and the low, kind of converge, that tells me this is factually where the buyers are in control. I have the most upside because it's really just beginning that trend, and I have the least amount of risk because my stop goes under this level here. Right. So that's where I have the most bang for my buck, and I can maximize my position because I have a tighter stop relative to the guys who buy up here. If they're using this low as a stop, they're going to trade a third the size and have the same amount of risk. Yep. I have 3 times the size that they have, and I'm taking a third of my risk off, essentially reducing all the risk, because now if it comes back to break even, I'll get stopped out at that break even. But if I took $1 profit on a third of it, I'll still make 33 cents average on the full position.
Yeah. Fair point. Got it.
Okay, so again, buying the dip. I don't want to belabor that point over and over again. So as you just observed, and I should have labeled it on there, is that from swing highs and swing lows, regardless of the time frame, from earnings. So here this company reported earnings that gapped lower, but look what happened. The buyers came in after a couple of days and retook control. Now people will sell the say, hey, my target is the gap closure. Fine. But then again, they had another earnings report and another earnings report. So it, once it gaps here, we anchor another volume weighted average price, and look at how well that was defended. We had a little shakeout prior to the next earnings report. And then, this was the next earnings report. So we anchor a VWAP off of that, and look where the buyers showed up again. So from this one, buyers took control. It didn't pull back all the way, but it maintained above that. We had a new momentum event, once again, earnings, buyers defending it over and over again, showing that this is how institutions buy. They say, I like that. I like the earnings report. Let's buy 5 million shares between now and the next quarter's earnings report. And we want to buy 5 million shares. So we're going to space it out. And anytime it gets down to VWAP since that event, we're going to be in there with strong bids. That's what's happening. They're trying to absorb as many shares as they can because that's their fair value since that event. We're anchored here. We're not anchored to the beginning of the day. We chose that. Then we could anchor one here and it would look like this, right? And we could anchor one here and it would look like this. So we want to be a buyer there if we missed it somewhere over here. It would look like this and this. It would look like this. And, this time it gapped. And again, we anchor it there. Buyers came in and defended it. So they're great for using it as stops as well. When it tests that volume weighted average price, this is what I called a handoff. We then say, okay, it tested that successfully. Then prices pushed higher. So if I am a buyer here, this was an important higher low. Maybe I'm going to set my stops underneath this rising volume weighted average price. So it's a really versatile tool to use for entries, for stops, for exits. It's dynamic support and resistance. It's not just horizontal support and resistance. So from this low in January of whatever this stock is, buyers emerged each of these times. It wasn't perfect, but this is a level of interest. And when we see that level of interest, we look at it on shorter term timeframes for the evidence. And maybe we buy it right here, or maybe we buy it right here, or we buy it right here with our stop under there. Or we buy it right here. We're not buying it. I'm not buying it at least right on the touch. I want to buy as it says, yes, that was support because we moved away from it. And now if it breaks below that, then I'm going to stop out. And then the VWAP starts to turn sideways. It breaks down. Now, instead of being support, it became resistance there. So if you want to flip to the short side, great, but you certainly have no business still holding it long. Plus it's traced out at, head and shoulders pattern as well, this being the neckline. So you've got to tie it all together for the most chance of success. And that, comes with decades of experience where you can just see that happen. But like any form of, Vivek, of support or resistance, the more times it's tested, what's happening? More likely it is to fail. It's not bouncing with as much vigor as it had in the prior ones. Instead, it's just kind of running out of steam here. And then it closes below it. And then it starts to make a lower low. That's a clear sign. Get out, because now the direction of the VWAP also from that event that was pivotal to your entry is declining. So getting out right in here and avoiding this mess is huge. It tells you that it went from a period of buyers in control, kind of neutral. So stage 2, stage 3, stage 4 decline. And we use that as our reference point. Then we can draw a VWAP off of here, and VWAP off of here will look like this. And then we can do the same thing over and over again. We can draw one off of off of here, and it'll look like this. We can draw one off of there, it'll look like that. Off of here, it'll look, so over and over again is what we want to do.
Brian, just one question. Sorry to interrupt you in the middle.
Yeah, no.
This analysis, obviously, you can't do in the entire stock universe. So you will obviously select your stocks that, okay, this is my number of stocks which I'm going to follow, and I'm going to only trade on them because I've been following them for a long time. Is that your model, or you scan all the stocks of US markets and see which one is satisfying your pattern, and then you use that stock?
Yeah. So again, I've been doing it a long time. So I have my process personally is I do all my scanning manually. As I mentioned earlier, when I click a symbol and then I just arrow down on my list, it populates the weekly, the daily, the 65, 30, 15, 5-minute and 2-minute timeframes. I'll jot down notes, on a piece of paper, and then I'll put little marks next to them. And that becomes my list for the next day. And I'm not necessarily looking for longs, and I'm not looking for shorts. So I don't want to go into it with a bias that says, hey, the market, turned around today, I'm going to look for longs. Maybe some stocks are still shorts. I don't know. Let's see what each stock, I like to trade each stock on its own merits. Sure. I'm aware that the Fed is is got a meeting this week, and they're going to announce on Wednesday. So I don't really want to, and I don't have any swing trades on now. I'm most likely, if maybe I'll hold something overnight tomorrow, but I'll most likely sell them before the Fed event on Wednesday. I have to be aware of the different market conditions we're in. We're in a period of heightened uncertainty and a lot of volatility. So I need to shrink my time frame. So I'm just looking for opportunity, and right now on shorter time frames. So, as all these stocks are kind of broken at this point, and they're down too much to short, or they've rallied too much late in the day to become a low risk entry point for tomorrow, I'll start looking at the shortest time frames and start out as a scalp trade. And then if that continues to hold the VWAP that I was looking at from tomorrow morning's 1048 low or whatever it might be, then maybe I turn it into a 2-hour trade, a 3-hour trade. And if it continues to do well throughout the day, I'll sell pieces of it, and maybe I'll hold a little piece overnight if I perceive that's the right thing to do based on the market, the way it ended the day and that sort of thing.
Sure. No, so, my question was that when you're doing this manual scanning, so,
Yes.
I mean, you can't scan 1,000 stocks, right? So in manual scanning, obviously you have your own stock universe, right?
Mhm.
So do
Yeah.
you follow that I will scan these 100 or 200 stocks and I'll only trade in those number of stocks which I have?
Yeah. So my process, Vivek, is on the weekends, I look at what I call my master list of stocks. And that
Okay.
is a little bit over 1,000 stocks. And I look at each one of those. And it sounds like a lot of work, but I can do it in about, if I'm really focused, I can do it in about 90 minutes. If I'm kind of screwing around looking at emails and pulling up stuff on YouTube, then maybe it's 3 hours.
Yeah.
But the goal of that session on the weekend is to get a list for the next week, and that'll typically be about 200 stocks.
Okay.
Now, of those 200 stocks, I know I'm not going to trade probably 170 of them. I might trade 30 of them over the course of the week. But there's stocks on there I want to just keep an eye on because I know the banks have reported. I want to see how they are they going to continue to decline the way they have, the way JP Morgan, got smashed off of earnings last week and has been obliterated since. I want to have some energy names in there because energy names are strong, even though I don't trade energy names. I want to look at some of the key tech names, even though I might not trade Google. I want to be aware of it because it's important to the market. But I'll get my list down to each. So that 200, I look at each and every day. So on Sunday, I look at it and say, here's the 20 or so I want to really look at tomorrow. But of that 20, I'm setting alerts on maybe 14 of those stocks. And on 5 of those stocks, I consider them my A to B list ideas, the ones I really want to focus on because they're curled up really tight within a range. And if they go, I know I can get bigger share size. They're in a favorable group is what I'm thinking maybe. It's got the volume, the range is tightened. There's pinching between a couple of important volume weighted average price levels. They just have the look, they held on the rising 20-day moving average after a 61.8% retracement of the prior range. The group is hot. All those things become very small deciders in what becomes my real focus list. So again, I'll set maybe 15 alerts. And going back to our earlier example of the stock that breaks above $30.50, I want to buy it above 30.50. What I'll do is I'll set, if it closed, if it closes today at 30.27, I'll set an alert maybe at $30.42. So if I'm not watching it carefully, it reminds me to take a look at it. If it looks like nothing's happening, I'll reset that alert for $30.47. 10 minutes later, I've kind of forgotten about it. It's done nothing. 30.47, I look at it, I put it on a level 2. Ooh, I got to pay attention here. It looks ready to go. In fact, boom, let's clear these offers. Let's get this thing going because I saw that, I saw that Applied Materials and ADM are going, AMD are going, and this little $30 semiconductor, if I give it that nudge, other people are going to notice and they're going to get involved here too. So
Sure.
It's just kind of all those things coming together. And of course, there's ones that I want to anticipate too. My analysis a lot of times is, I hear of these 20 stocks, I know 10 of them aren't ready today, but I want to start to see how they develop during the course of today. Because if they come down and touch that 5-day moving average and make a higher low, and it comes down between that VWAP off the peak 3-4 days ago and puts in a higher low, then maybe it's a good idea for tomorrow. So I just want to start to get more familiar with them. So I'm not just pulling up symbols I've never seen. So there's a pretty core stable in that 200. And by looking at them each and every day, I get a better feel for what's happening under the market than just by looking at the S&P or just looking at the NASDAQ, because I have energy names, I have, bank names, I have tech names, I have gold names in there. I want it, and I look down at my list and say, I've got 3 gold names here. I haven't seen 3 gold names in 3 years. What's going on with gold? So, they'll often lead the GDX. So I'll look at the GDX and say, I could see how that could get going if these 3 stocks, which appear to be the leaders, do break out and continue to move higher. I could see why other people will be attracted to this group. So I feel like I get a head start by doing it manually rather than, putting in scans and saying, here's the cookie cutter pattern I'm looking for. Now, market, fulfill my order. I want to listen to the market rather than tell the market what I want.
Sure. Great answer. Thank you.
Okay, so we've covered, as you pointed out, from swing highs and swing lows, from the beginning of the day, week to date, month to date, year to date. And it's not like I'm looking at every single one of these on all stocks, but if it happens to be relevant, especially now, we're January 24th, we've got about 18 days of trading, I think. So I'm looking at basically the 18-day VWAP. The year-to-date VWAP is important because that's an important benchmark that people are measured against. We start our scorecard at 0 on January 1st, right? Your fund managers and how they get paid in that. So again, we've covered, week to date, daily, the second day volume weighted average price, from earnings, from gaps, and from IPOs. IPOs are really one of the cleanest ways to look at the volume weighted average price because we have a defined starting point for everyone. It's the same for everyone. Unless you got shares on the IPO itself, the actual trading in the once the market opens, everybody's on the same page. We know that it opened at, whatever this is, $45.63. So what I'll do, and you can see here, I have 2 different colored VWAPs. I've got this blue one and I've got this purple one. The purple one is to the very first candle of the day.
Okay.
And this is a 1-minute chart. And what we see there is the biggest volume. Typically, that's typically the biggest volume for the next couple months on a 1-minute candle, because the people who got it on the IPO are flipping it out maybe to the market orders. So this is a negotiated transaction here. It's not real supply and demand after it begins trading.
True.
So I put VWAP on that first minute, but this is where the actual trading begins, on the second minute. So I'll put one on the second minute as well. And you can see here that that's where it pulled back precisely to. It didn't pull back to the VWAP from the IPO, but from the second minute. And then, the next day, you see that now we're on a 5-minute chart. So just from the 5-minute candle is fine. Here's day 1. This is day 2. The third day, look at where it opens, right on that VWAP from the IPO. It rallies up. And again, we could put a VWAP off of that low and it would look like this, and off of that high right there. And there's your buy with your worst case stop under here, or maybe even under this little low right there, that higher low. And we get a phenomenal rally from 64 up to 68 and back up to 71, 72. And then we see lower highs and lower lows. And this VWAP will look like this. And then we'll put one off of here. We can put one off of here, etc. And, we want to buy these consolidations, breaks of consolidation. Here's a couple other IPOs, not really as important. We're running an hour and 20 minutes here. So I want to, keep it a little concise, but, even a year later, 6 months later, the VWAP from the IPO, you'll see often is defended and over again until we see that role reverse, where it breaks down hard on a gap. It tries to bounce there, fails, gets stuck under it, and then test it. Now the average participant, the average short is defending it. The average long is saying, oh boy, it makes the lower low there. If that's not a clear as heck can be signal to get out and avoid it, I don't know what else is. And you can say, well, sure, that's traditional support. And it is. But here we know the actual price, the actual average price, factual. You cannot, you can't argue that that's not it. The actual price, that is. So let's sum it up. Where do we anchor from? Breakouts and breakdowns, Federal Reserve. So we'll see that on Wednesday at 2 p.m. Eastern, when the Federal Reserve announces. The S&P will look like this in the morning, and then it'll kind of go flatline. And then the Fed, this will be 2 o'clock. The Fed will announce, and it'll go like this. and then it'll either go like that with the VWAP underneath, or it'll, get the snot kicked out of it and stay below the VWAP anchored from that 2 p.m. event. So FDA reports, when Pfizer gets a new vaccine approved, is it worth buying on that gap up because it fails and continues lower? People say, wait, what happened? Who cares what happened? They're sellers. Don't try to buy it. Don't fight it. I like to use it for short squeezes to identify where the shorts are positioned. What's the average short price approximately? Where will they feel pain? So if I can see that the short interest went from 3 million shares to 4 million shares, 8 million shares in the last 8 weeks, I can look at the VWAP from the last 8 weeks and say the VWAP from the last 8 weeks was $28.75. The stock is at $30.45, and it's about to break out. Well, those 5 million shares that were added are definitely feeling pain because the VWAP from the time they added was $28.75. So we know that they're going to feel more pain and possibly, go in and cover. The open of the trading day, that's simply the VWAP. The only difference is, and I use the term sometimes interchangeably, and people say, Brian, do you mean the anchored VWAP? Right. I'll say the VWAP from the gap. So the VWAP anchored to the day that it gapped. From an earnings report, it might have caused a gap or just a regular breakaway gap because there's, the technical events. Year to date, week to date, month to date, any significant event that changes the supply and demand dynamic, highs, lows, big volume candles often are a good one. It's just the easiest, quickest way to say factually who's in control, the buyers or sellers. And I think that's my last slide, except for this. Don't forget, we have all these cool little indicators and oscillators, but there's only one thing that matters. Price. Only price pays. I have to include that on every presentation because I say it 1,000 times a year. It's the only thing that matters. Don't argue with price. It's the only thing that matters. So here's what I do. I've got to do a 30-second pitch. My book is on Amazon. It's been called one of the top 10 ever written. Look at, my work on Twitter. If you're interested in my subscription service, send me an email at this address and I'll give you a good deal. And that's all I have here.
My goodness. And I'm just wondering why I haven't met you earlier, because you would have shaped my trading career quite differently, I'm sure for good. Thank you so much, Brian. It was such a pleasure talking to you. I'm waiting for this book and I'm really waiting for the next one, which is going to come very soon. What's the timeline? When is the next book coming?
Oh man, I'm not a natural writer, Vivek. I started the first words of this book probably 2 years ago, and I wrote for about a month, and then I put it down for 6 months. I got motivated. I wrote for a little while, put it down for 8 months. Now I'm on a good. So the short answer is, I hope I have it written April-ish and in print by June, July. Let's see.
Yeah. Fingers crossed. We are eagerly waiting for it. And Brian, you have given it all to all of us. Thank you so much. Really, really, it has blown my mind. It has given me so much. And I'm going to start using Anchor VWAP from today itself, because yesterday was an important day. A lot of volatility. So this is a great time to experiment this particular utility. Brian, thank you so much. It's an absolute pleasure to interact with you.
Great. Thank you for having me on.
Thank you so much. And friends, Brian's book is there. The link has been given to you. Use it because you don't get it think so easily the way Brian has given to us. Thank you, Brian. Have a good life ahead. And we'll be in touch through Twitter. Thank you.
Okay.
And keep watching the Indian markets because we have really good volatility to play on as well. You may not like to trade, but it's a good market to observe.
I don't want to trade all night. You guys are just opening right now. It's 9:30 local time, 9:30 at night. So
yes. All right. Thank you. Take care. Take care, please. Thank you.
Okay.
Bye.